The idea of these is that we're sort of identifying an issue, whether that be, a social, environmental, etc., and then where the asset manager, as in Pictet, have got something that they think is looking at something that needs to be changed, where the dial needs to move, and then how, in your way, you're trying to align client money with that change.
Mm.
So the issue that we're going to talk about today is around SDGs and how the transition isn't happening as quickly as we'd hope it is. And then how you, with your fund, with the fund you work on at the moment, are trying to, at least with that bit of client money, to address that issue.
Yeah, absolutely. And I think it's something that we think is a massive challenge, but a massive opportunity as well. And so maybe to provide a brief intro into what the SDGs are, because often they're banded around and maybe some people don't know the acronym, but the SDGs are the UN, United Nations Sustainable Development Goals. And they were developed in 2015. It's a list of 18 goals that really span the breadth of environmental, social, and kind of governance related, government and peace targets that would provide what we perceive to be the best framework of what a sustainable world and economy would look like. Those targets were launched in 2015 with the target date of 2030. And they very much were in the front of the kind of public's minds at the beginning of this decade, but have kind of fallen off. And I think what has been highlighted for us recently is there was a report released in August this year by the UN, which stated that we're 2/3 of the way through this program, and only 35% of those targets are even on track or making any kind of progress. In fact, more than half are static, if not in decline, and 20% are actually regressing quite dramatically. And so that for us gives a bit of consternation. While there have been very strong positives in the last decade or so, to speak to one on the environmental side, 92% of people now have access to electricity, which is a phenomenal number globally. And then on the social side, we have things like 50% of the world population are now covered by some sort of social protection, up from just 10% in 2015. We've seen those positives move, but those negatives that are regressing have real risks for us in the real economy, but also as an investment perspective. So firstly, I think we all appreciate CO2 is now at its highest level in 2 million years, and we are seeing climate records being shattered by the day across 2024. That creates a lot of instability, which for portfolio building is not something that you want, and it really challenges your ability to think long term. And the ramifications of that on the social side are huge. I think another point that they pulled out of that report was 120 million people are now categorized as displaced, so not living in the area that they were originally. I mean, that's either by war or by climate. And so that also brings significant instability to governments or societies. So that is the big challenge that we see today.
I think the thing is as well that, bearing in mind the SDGs when they were launched weren't actually intended as an investment framework or anything of that sort. And I think it's fair to say they've been manipulated, shall we say generously. I think that they're definitely a very useful thing, and I think that they help enormously in terms of framing some of the discussions. I think some of the ways in which they are applied is frankly slightly embarrassing, but that's a whole other conversation that I'm not going to have with you, because that would just be.
I mean, we absolutely can have that conversation, Mike. I think it is very important to address that, right? And I think the last time we spoke was around the topic of greenwashing, and so this is one of those areas that does get flagged, which is that the UN SDGs, as you well mentioned, were built for countries and supranational organizations. And so the sub-targets within them are government and kind of country level. And so applying them to companies is somewhat difficult. And it's therefore very important that you make that distinction. And it's something that we try to address with what we call radical transparency within our strategy. And I know we're going to come on to the solution part, but I think it's really important to address that now, is that we don't just say this company is good on an SDG3 basis. We make that specific link between SDG3 being good health and well-being and what we see as a company-specific KPI, so that you as the client or anyone else who's scrutinizing us can see what we're identifying as a link between the two and hold us to account on that front. So it's absolutely right. SDGs are not built for companies, but companies are part of the global economy and part of these countries, and so have a role to play within driving change there.
it's good to hear someone talking about it and actually being that transparent, because I think that's where the issue comes in, that there are, dare I say, some organizations that just take the number on the page and they say it must be true. And sometimes it's definitely not.
But I think, I mean, maybe to address one more point of that, and that can lead into our topic going forward, but that's also for us, when we talk about addressing sustainability, we really focus on the products and services that the company deliver, right? Because that's the real impact that they're having on society. Yes, we focus on what we would call more of the ES and G parts of how a business operates, but really our focus was on products and services. What ramifications of what you're selling into the market do they have positive or negative impacts on the UN SDGs? And the reason that we focus on that is because that is really financial return generating. If you make that product better environmentally or socially, it can have, doesn't always, but the improving impact there can have incrementally positive returns.
And those are the two things that clients want. They want to do good with their money and to make money with their do good.
Yeah.
That's not a slogan that's going to go particularly well, I don't think.
No, but I think, you're absolutely, I think we need to be aware of the fiduciary duty that we have, which is actually, I would flip it around the other way. Clients want to make money with their money, right? They have certain objectives that they need to, whether it's their pension, buying a house, saving for their grandchildren, one or the other. That is the preeminent focus that we have to have, is generating financial return. And a lot of people have the secondary objective of, we want to do good with that. We don't want that money to create further harm. And so we have to be focused in sustainable investing around generating return. This is not an altruistic exercise. We are not a charity. We have to generate returns for our clients, but doing it in a way that contributes positively and socially is how we can get that, what I would call more of a sustainable market around this, where we do generate that financial return that is required.
So what's your solution then? Because I think we've identified where we're at. I mean, obviously there's the thing, as you say, there's a lot of headwinds because of people talking about net zero is nonsense in this country, people in America, etc., and their resistance to what they see as being constraints upon whether it be socially, politically, financially, etc., which I always say I find peculiar, that you've got the president of the United States, his grandfather, who doesn't seem to care about the planet he's going to leave to his children, let alone his grandchildren, which is kind of peculiar. But there's an awful lot of companies around the world that are trying to make things better.
Is within positive change, the strategy that we launched 3 years ago, but have been building a couple of years before that, is really targeted to identify through a kind of 3 different steps, quality businesses that are improving the impact of their products and services in a way that generates incremental financial return. So as I mentioned before, that's for us the most important part, is that these businesses are quality, they generate already financial return, and every step that they do to whether create more positive environmental impact, reduce environmental impact, or create more positive social impact, they do so in a way that is incrementally profitable for them. That then solves the challenges we have around kind of people's reticence to engage with sustainability because it doesn't generate financial return. And we also think that they can not only drive, but also benefit from the transition to a sustainable economy. So that's the first piece. The second piece is, because we're looking for incremental return, incremental impact improvement and incremental return, we can really do that across the entire economy. And that's incredibly important. We're not going to meet the SDGs if we only focus on one specific part of the economy, whether it's just mining, because then we're not looking at the use of those materials. If we're just looking at energy, we're not looking at the use of it. We have to look whole economy. Looking at improving impact, it means that we can look in that way. And then that enables us, given that kind of holistic view, we can then build a portfolio that reflects that is diverse and balanced. And so we don't necessarily have a portfolio that some sustainability funds do have, which is skewed towards factors or geographies or industries, then means they're very cyclical and prone to sentiment. So that's the second way. And then the third way that we really differentiate is that we help drive this change. We're not just identifying companies that are benefiting from a transition to a sustainable future, but we also help drive that through the active ownership that we employ. Because we're owners of this business and we think long-term, as I mentioned at the beginning, Pictet's long-term view, we can work with these companies to affect change within their strategy that we think has positive outcomes, environmentally or socially, but also has positive financial returns. So really what we're trying to achieve with Pictet Positive Change is to be an all-weather sustainability solution, build a portfolio that is diversified and balanced, create change with your capital through engagement and have a more steady financial return profile that enables you to invest for the long term. We can have these sentiment shifts where suddenly something's in vogue today, but actually doesn't make real world sense. And I think one of the best examples for us of how we're able to manage through that is a company that we've been invested in for 3 years or so, which is called Williams, which is one of the largest US midstream companies moving natural gas around the United States. Williams was kind of written off because of its fossil fuel exposure, but we, having done detailed and fundamental work on the industry, realized that renewables create intermittency issues that we're now seeing today, and so you needed a base load power that was able to provide a backstop within power generation when the sun wasn't shining, the wind wasn't blowing, and that was really gas with a lower emittive profile than coal in the US. And so a critical piece of infrastructure to move from the gas basins to where it's needed in urban centers is something like Williams. And this company was trading at depressed valuations. We started working with the business and got very close to management and have been engaging with them around their ability to showcase to investors that they have the role to play within reducing environmental impact, not only from providing gas, as I mentioned, can offset coal use on the eastern seaboard in the US and have massive reduction of CO2 intensity per unit of power generated, but also this is critical for us when I talk about impact improvement generating financial returns. In Williams's case, with many pipelines, one of the worst parts of emissions is methane leaking out of the pipe. But that methane that is leaking is literally the product that they sell. So any leaks that they can reduce just means more dollars that they create at the end of the pipe when they sell it. And so they have been undertaking an emissions reductions program that has a massive payback for them in terms of reducing their emissions, but also generating more value of it at the far end. So for us, that just highlights, as you said, we need to work with these businesses through the transition. If we can also improve them while we're doing it and make money, all the better for everyone.
I like that because there are lots of very pure funds, and that's fine. But the reality is, as I sit here, and it is a gas boiler, but it'd be cold otherwise. Gas is better than coal. Gas isn't the solution. We need to, it's the getting there part. And I think that within that, there are different pieces, that new nuclear seems mad, but we can't turn the lights off now. So we keep the ones going, hopefully in a safest possible way, and so forth. And I think that I like these sorts of, I think one of the problems, because I've been doing this, as you can tell, for a very, very long time, that people get a bit sniffy about the stuff in the middle.
And that's really the thought we had, right? As you mentioned, is that those companies in the middle, they're not valued as being going concerns for many decades, even though they will be because they're required to help that transition. And they also have the ability through that improving impact to access new markets, so more revenue, potentially sell these products at a premium, and they can potentially reduce their costs. So for us, we really see two sources of return, of alpha drivers. It's the re-rating as they get valued as a longer term play, and then it's the actual improvement of their operations today. But I think it's also really important to say that when playing with companies in the middle and helping to engage and move them towards a more sustainable profile, it's very important to make sure that you identify those companies that have the ability and willingness to change versus those that don't. And that's because we firstly want to make sure to our clients that we're doing what we say we're going to do. We're not just buying a company that's involved in oil because the oil price is going up. We're buying a company that is involved in legacy energy because we believe it has the ability to straddle to a new energy supply. But also we think that those would be bad investments because businesses that are not able or unwilling to change will over time become obsolete and start to run down their returns. So it's important for us. We definitely play with companies in the middle up towards the top end, and we try to avoid those that have whether it's tobacco or alcohol, things that don't have any positive impact today on society.